Introduction. The backtest illusion. It is one of the most common and frustrating experiences in quantitative trading. You develop a strategy, meticulously backtest it, and the equity curve soars, a beautiful, near-perfect upward line. Confident in your creation, you deploy it with live capital, only to watch it bleed money, underperform, or fail completely. The flawless performance on historical data was nothing more than an illusion. This gap between backtest brilliance and live market failure has a name: overfitting, or pre-optimalizes. It happens when an algorithm is so finely tuned to the specific noise and quirks of a past dataset that it loses its ability to generalize and adapt to new, unseen market conditions. The strategy hasn't learned a true market edge, it has simply memorized the past. But what if the solution to this complex data science problem could be found in a completely different field? The answer lies in the rigorous, process-driven world of manufacturing and its premier quality control methodology, Six Sigma. By treating your algorithm not as a creative masterpiece but as a factory product, you can systematically measure and eliminate the defects that cause it to fail. Takeaway 1. Your trading strategy isn't an idea. It's a factory product. The first and most critical mental shift is to view your trading strategy not as a flash of creative insight but as a product rolling off an assembly line. Imagine your development process as a factory and Six Sigma is the inspection team. The goal is to produce keys, trading strategies, that are universally applicable, capable of opening not just one specific lock but a wide variety of new ones. In this manufacturing framework, overfitting is not a vague concept, it is a critical defect. It's the equivalent of a key engineered with such intricate precision that it fits a single, old lock, the backtest data, perfectly but is too specific to open any new lock it encounters, live market data. The factory inspection team, using tools like FMEA, would immediately flag this too perfect key as a high-priority problem because, despite its apparent perfection, it is fundamentally useless. Takeaway 2. You can assign a precise failure score to your strategy. Six Sigma provides a powerful metric to quantify the quality of a process, DPMO, or defects per million opportunities. By applying this to strategy development, we can assign a concrete score to the risk of overfitting. To do this, we must first define our terms. Defect: a strategy's failure during out-of-sample (OOS) testing, where its performance falls below a predefined quality threshold. Opportunity: every single out-of-sample test cycle represents an opportunity for a defect to occur. This allows for a powerful analytical capability unique to the Six Sigma framework, multidimensional DPMO. It enables you to isolate and separately measure strategic design defects, like overfitting, from operational defects, like execution latency or drawdown breaches. This provides a far more precise diagnostic tool than a simple profit and loss metric. The calculation for the strategic design defect is then straightforward. DPMO equals number of OOS failures, total OOS tests, *1 million. A low DPMO score indicates a highly robust strategy that consistently performs well on unseen data. For context, the benchmark for achieving a Six Sigma level of quality is just 3.4 defects per million opportunities. Takeaway 3. The most dangerous flaw is the one that looks perfect to proactively manage risk. Six Sigma employs a tool called Failure Mode and Effects Analysis, FMEA. FMEA identifies potential failures and prioritizes them based on a risk priority number, RPN, calculated as RPN equals severity x occurrence x detectability. When applied to algorithmic trading, the analysis reveals a startling truth: overfitting is the single most dangerous risk. In one such analysis, overfitting was identified as the number one priority risk with a risk priority number, RPN, of 560. The reason for this extremely high score lies in its components. The severity, S, of an overfit strategy failing in a live market is catastrophic, assigned the highest score, S equals 10. Its detectability, D, in standard backtests is extremely low, as it masquerades as a perfect strategy, warranting a high score of D equals 810. Combined with its known probability of occurrence, O, in any strategy development process, these factors make it the highest priority for mitigation. This leads to a powerful conclusion. If a strategy fails in out-of-sample data, it is almost certain that overfitting to the training data has occurred. Takeaway 4. Factory floor tests to build a more robust algorithm. Once FMEA identifies overfitting as the primary risk, the Six Sigma framework provides a toolkit of controls and tests designed to reduce that risk by making the defect easier to detect and less likely to occur. These are the factory floor quality checks for your algorithm. Out of sample, OOS testing _ this is the first and most critical line of defense. By validating the strategy on a segment of historical data that was not used during its development, you can quickly expose a lack of robustness. Parameter sensitivity testing _ a robust strategy should not collapse if a parameter is changed slightly, e.g., a 12-period moving average to an 11 or 13 period. If minor tweaks cause major performance degradation, the strategy is likely overfit. Sufficient sample size, min-BTL, _ a strategy's statistical significance depends on adequate data. To reduce the probability that your algorithm has simply fit the random noise in your dataset, its backtest must adhere to a minimum backtest length, min-BTL, that is sufficient relative to the number of configurations tested. Cross-market validation _ a truly robust logic should be generalizable. Testing your strategy's core concept on different, uncorrelated markets is a powerful validation that you have captured a real market dynamic, not just an anomaly in one dataset. Conclusion. From, is it profitable? To, is it robust? By adopting the principles of Six Sigma, strategy development can be transformed from a speculative art into a rigorous engineering discipline. This framework provides the tools to measure, prioritize, and systematically reduce the risk of overfitting, the most common cause of failure for otherwise promising algorithms. It forces a fundamental shift in perspective. Instead of only asking, is my strategy profitable? Should the first question be, what is my strategy's DPMO?